All right, stocks bounced back up today on a near-term basis. We were looking at that on the market forecast the past couple of days, and we got a little bit of a bounce here today. Well, I guess more than a little bit, but more than 1% higher on some indexes. So a pretty decent move higher to kind of offset the 1% decline that we had a few days ago. And we continue the trend, right? There's a lot of indicators are continuing to show how bullish this trend has been. I'm going to again continue to put this move in past precedent, historical context of what we've seen in the past, especially as we approach the end of a options expiration cycle. We'll take a look at that here. We're about to near. We're 1 week away from ending one of the strongest 5-month long expiration cycles that we've seen. 5 options expiration cycles that we've seen. One of the strongest moves. So I'll take a look at that. Again, put that move in the context, and we'll take a look at what's driving today's price action. Not surprising, but we'll break it down into different sectors and a big move down in the dollar today. And that's obviously the last 2 days really has really been quite the impetus for this bullishness, and we'll see how likely we are for that move in the dollar to continue to the downside and the strength that can continue to provide for the markets as it approaches some very strong levels that will just get stronger with continued weakness in the dollar. So we'll break all that down. Our trade idea stock in a consumer staple sector of all places that's also breaking out of an extended convergence period. We'll talk about how to trade that. So let's go ahead and get started. Today is Thursday, March the 7th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I review all the trades from prior Market Outlook videos to see whether we should stay in them. We closed out another trade today before adding our new one. We already added today's trade before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. It's really big to us. Is why we always ask. So thank you to those who like these day in and day out. Our goal is to get up to 100. So about halfway there. Those who don't click on that, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As we expected here, the near-term line bounced back out of bearish territory just like it did all these other previous instances. Again, we're looking for something different. Until we do, we just expect what we've seen before, and that is a brief little foray into bearish territory and a bounce right back up. If you look at it from this perspective, again, we know that we haven't had a 2% decline. We're now up to 25%. Remember, the record's like 26.33, if I remember correctly. Coming off of the coming in there, here we go, in 1995, coming off of the last rate hike. And the nice soft landing cycle that we had there, and that we're all hoping that this one ends up being the same. So that's how close. We're just 1% more away. You know, again, as I told our market scholars, I do expect that we'll hit that number and then some here. And of course, that move. Let's see, how long did it take that move to occur? That one occurred over. Let's see here, all the way up to 151 trading sessions. 151 trading sessions is how long that took. We are now, let's see here. We are now at 89 trading sessions. I'm looking at the bars up at the top, subtracting 1 out for the bar that I'm on. So we're now at 89. So we've gotten there a lot faster than we did in 1995. I mean, just a little bit more than half the time it took the previous time. So, and again, with a really low VIX to begin with as well. So a big move, as if we had a big VIX level here, of course, that we didn't. And really no volatility level measure was very high at that low point. So So, as we've seen here, if I were to change this to 1% though, so we haven't been without 1% declines. We've had plenty of those. Here we can see we've had, again, 1, 2, 3, 4, 4 of them, 5 of them this year, this calendar year, this last one being our latest one. And so again, after every one of those, the near-term line declines and we bounce back up. And that's kind of what we're doing again until we see something different. That's what we expect here. Closing at an all-time high. Intermediate line again above the 90th percentile. I mean, there's been a lot of instances here that it's been above the 90th percentile. It's not that common, again, for it to be that long. Even if I were to go back to this 1995 time frame here, sorry, it keeps moving on me. So right in this area, you'll notice even then there was a pretty extended period of time too that we were above the 90th percentile, but we had a little bit more. We had more smaller declines that brought it back down. We didn't have very long periods where we were up above it before we finally kind of peaked over. Had more of a decline that actually brought the intermediate line below 80, and then we finally had a little bit of a decline there. But you can see how we didn't have a full-on actual intermediate decline by definition until this very brief, pretty much 2-day drop that we had in January of 96. But that lasted, again, 2 days. We were right back up. The intermediate line got right back in. And then after that, in 96, you can see we had more of a traditional, a little bit typical time frame for an intermediate decline going into 97. Again, you had a kind of typical intermediate decline time frame there. A few times at the end of 97, of course. 98 had one of your bigger intermediate declines bordering on a correction. This was actually a correction because of how far down. You can see even the market sentiment line got closer to the low reversal zone. Got multiple clusters there at the worst of that scenario. So incidentally, the last time that we had that we were as strongly below that we had as many all-time highs by now within a year on a percentage basis was 1998. I saw that tweet posted out there today. 1987 was the time before that. 1964 was the time before that. You had to go all the way back over here. We all know what happened in 87 and 98. Here's 64. You can see by the beginning of 65, you had a pretty decent corrective move there as well, dropping during this intermediate decline here, dropping almost 10%. So again, correction level, bringing the market sentiment line also into bearish territory, multiple clusters. So again, 3 times that we've had. This is the 4th highest percentage basis year that we've had as many all-time highs as we've had so far by this date. And the other 3 instances produced volatility later in the year. So it wasn't necessarily the best thing to start off a year so bullish. Remember, we started off this year with a basis of a parabolic move to the upside. We ended last calendar year on a parabolic run to the upside, and then just continued it so far this year. So the Nasdaq, of course, looks very similar as today's biggest mover. One of the biggest drivers was a move in Nvidia and related stocks. The Dow Jones, which has been weaker, was also weaker today. That's no surprise. Remember, it got a bull tag, and it's actually still trading inside the range of that day that produced the bull tag. Though the bull tag did not drop very far below the moving average, so not necessarily expected to be like a trend reversal yet, at least. The intermediate line is below the 80th percentile, so that's a little different than the other major indexes, market sentiment, and below the market sentiment line, which is also different than what you see on the S&P. Though what we see similar, a little bit more of a drop on the near-term line, but though it didn't get into the reversal zone, did bounce back out, just like all the others, and is still below the intermediate line. So the difference here is the near-term line is still below the intermediate line, which doesn't matter on the other two because the intermediate line's in the reversal zone, like these 2 peaks. It does matter on the Dow because the Dow's intermediate line is not above the reversal zone. It's down below it. So now the near-term line being below it does matter in terms of not being nearly as bullish as it seems and then on a near-term basis. And not like we're going to be tanking here. The same thing on the Russell looks very similar to the S&P. The difference is the intermediate line is far higher than the market sentiment line than on the S&P and the NASDAQ, because its market sentiment line is still falling below the reversal zone. It never did get in the reversal zone. Remember, it's in the reversal zone for the S&P and the NASDAQ. Again, the near-term line coming out of bearish territory, just like the S&P. So pretty similar patterns in that regard. If I take a look at the weekly chart, here again you can see a higher high, higher close. We are in the 90th percentile now of the last 3 years. Of course, if I go out 5 years, it drops still in the 90th percentile. So we have moved up to 7.68%, which again, anything in the top 10 in the top decile gives you the green dot. Anything in the lowest decile gives you the red dot. So we're pretty extreme now in terms of this gap between the orange and the blue lines. Of course, the size of the candle is still below its average. It's three period average here, and it's been converging since the initial surge that we had. Looking at the 3 green arrow chart, not surprising to see that we still have 3 green arrows in the Russell, which we've had for a while, and now we do on the Qs. We don't have on the S&P. You're not getting very much momentum, and you won't, because we've already had the initial surge of momentum. Once you get that initial surge of momentum, it's rare to get another, right? So we had that initial surge right here. We did have a little bit of a surge here after a longer period of convergence that kind of rebooted the move. Obviously we are in a little bit of a convergence right now, though it's only been a few days. So you wouldn't expect to get a big momentum surge here, because we're already strongly in the reversal zone. Same thing with the Qs, right? You had your initial surge. You actually had 3 red arrows, so you get a new surge, but obviously not as strong. You wouldn't expect it to start a new leg higher, and then now you're not expected to get any surges in momentum because of how mature the trend already is. Looking at the 3 green arrow chart, you can see we're above all the moving averages. They're all rising, so everything's fine there. The diamonds is the only one that is a concern. It's moving. MACD is easily below its moving average and is a lot closer to 0 than the others. Stochastics is now out of bullish territory. We had a couple of days below the 17-day, though we rebounded today. And again, the bigger gap between these moving averages gives this index more of a poorer margin of safety than the other two. So that's something to keep an eye on, to see if that's a sign of weakness that can lead to other weakness in the other indexes as well. Looking at the DMI, again, we're still strongly bullish. We're not back above 40 yet, but we are back below 25 on the negative indicator, so your ADX is still easily above 25. The weekly, this is just very strong. You're up to 35 almost, or excuse me, you're above 35. You're at 36 on SPY. The negative indicator is now back below the 10% figure here. So again, we are extreme. Like, it's already, just being as high as we are, not quite above 40 yet. That's really extreme. So we're not quite there. But to have the negative line being below 10 is pretty extreme on that level. The Qs, not so much, and you can see its positive indicators actually dropped below its ADX line, so a little bit of a pause, suggesting same thing on the Dow. The Dow did get that orange arrow down there with the negative indicator below, and of course your IWM. The ADX is not even above 20 yet. It's trying to get there. It's just barely. So again, no significant trend yet on there. You are getting one. You're starting to get more of a trend. SPY is now above 20. So we can move this now. We have reached the 20 level. Again, we haven't reached 20 since the early part of 2018, and it's just not very common at all for us to reach 20. 2018 is the most famous example. We were just extremely parabolic there. You can see we were pretty much right at 20 there, coming off of the 2006 last rate hike cycle. And then we went into 2007 with a big bullish move, and we saw what happened a couple years later. If we were to go out we know what 2018, what that brought when we got to 20. We did hit 20 over here in 1997. Of course, we went sideways for the next 6 months. We had a good strong move to begin 1998. That's the one I just mentioned. I think that might be the third highest. That's one of the three years, beginning of the years to this point, that we've had on a percentage basis had more all-time highs. But again, you saw what, again, it's just how bullish that was. And then, of course, in 1995, coming off that last rate hike there, you saw just how parabolic. We almost got up to 40 on that level. Very, very extreme trend at that point. And we maintained the bullish trend for most of the next so many years. Again, a lot of people kind of hoping, and we all kind of hope that we can get that kind of run again on the markets. Now, the CAPE ratio, the long-term valuations, the CAPE was only at 10 at the beginning of 1995. We started this particular parabolic move. In fact, we started the whole run in late 2000 or beginning of 2023. The CAPE ratio was at 28, so we were already 40% higher to begin with. In fact, by the time we got up to 34, which is where we're at now in the CAPE, way over here in 1998. So it took multiple years to get where we've gotten to in just about 1 year, a little bit more than 1 year, in terms of how bullish we've been. Looking at the Keltner channels, and well, let's look at the RSI really quick. The RSI and the CCI, again, very strongly bullish, both of them at bullish levels. Now let's look at the Keltner channels. Again, we are back up above the upper Keltner channel again. So, that's when you're above that upper Keltner channel and the bands are outside the Keltner channels, you have strong momentum. Again, one of the longer runs of positive momentum that we've had without a break to negative momentum. So very good move. That's what happens when you're above the Keltner channels. You're in the upper quartile of the bandwidth there. The whole moving average is strong. It's still green. It has been for a while. We only had a few days of red over here in February. We had a few more days of red at the very beginning of the year, but we haven't had like a 20-day decline. But you also notice we are converging with the 200-day haul. So, you're going to have your initial surge early, and then you're just going to converge the rest of the time. And that's just kind of what we're doing right now on a weekly basis. Again, we're very, very high on a 5-year level relative to the 200-week haul. Again, one of the highest levels of the last 5 years. Again, only this move off the 2009 low, that extreme move up, kind of compares with the kind of move we're having right now, as well as the move off the COVID low. So very similar moves, but again, a lot smaller of the time frame, right? Because this has only taken just a few months to get from zero up to the high levels. But the parabolic SARs are there. It's been almost 20 weeks since the 20-week hull has been green, and we're barely closing up above it. We were easily up above it there. Now we've been, since we had that little convergence period at the beginning of the year, we've been barely closing up above it. So just something to keep an eye on over the next so many weeks. Finally, let's see. Let's look at a few other charts. Let's look at the intraday chart. We did get a new high today, so that sets us up for another 100 on the hull. So that's a good sign there. We did get another common gap today, so more likely we're going to fill in that gap sooner than later, just like these last two. And you'd expect we'll still fill in the rest of this gap, though the point of control is kind of at yesterday's low point there. Will make it a little bit more difficult to fill the rest of that in. We are above last week's high point as of right now. It's bullish as of now. The low point for this week compared to last week is only slightly higher. But like I said, still up in the upper half of that chart, up above this line, and that's the stochastics I showed you here yesterday. So right back up to the 96th percentile, the 4-week range, back above its moving average. So everything looking really good from that perspective. You saw the volume, the range, it was a little bit above average on the range. The volume is actually a little bit below average. Remember, that's, we're kind of watching these. The volume is at extreme lows right now, 52-week lows on its average, but the ATR is slowly starting to rise. We saw that the VIX has been slowly rising too. In fact, we're almost done with this options expiration cycle. You see the VIX is still above 14, still above the 90% mark. I find it interesting here that we are, we've had 5 straight options expiration cycles of bullish moves to the upside for SPX. In fact, again, one of the, there's only 2 or 3 other moves that have been bigger than this over a 5 expiration cycle basis. But what I find interesting is that we're about to end, right? What I find interesting, though, is the last 3 options expiration cycles, the VIX has actually rallied. Of course, not surprising that it dropped here, but it rallied on these others. It kind of give you a sense of what the VIX did on some of the other moves. Here, let me bring up a different chart, and let's go to this chart. I mean, just to kind of give you a sense of what I'm talking about here. Let's change this to 5, since we're only a week and a day away from this expiration cycle ending. And let's go out to 1957. Go options expiration. Okay, so we are at 22.22. It's a little bit lower. I did this earlier today in class. 22.22. And then let's go out on SPX, so we can go back out to its time frame. 22.1.09. Okay, so you can see, like, for example, coming off the COVID low was a bigger time frame. Coming off the bear market low of 08 was a bigger time frame. In 1999, we had a big 5 expiration cycle move off of that negative decline that we had in 1998, the 5 cycle decline. You can see in 1984, in the 80s, coming off that bear market, 81, 82, coming off that bear market, ending the this little bullish run before we had the bear market there, coming off the 73, 74. But for an example here in June, July, this last July cycle, if you look at the VIX for that cycle, 2020. So here is the five expiration cycles that we had that big move, 1, 2, 3, 4, 5. So only one of those were to the upside, and we continued down. Same thing with 2000 off the 2008 low, 1, 2. It's like right here, 1, 2, 3, 4, 5. That's the 5 cycles that we rallied. So all of these, the VIX was coming down. Volatility was, no matter how you measure it, was coming down. But here you have 2 that were down, but then now 3 that are actually slightly higher, and the VIX, is still kind of trading above average values, flirting with getting above that 200-day average. In fact, 3 days in a row now, we spent a little bit of time above the 200-day average value, flirting with getting above 15. You can see that's a significant level. 15 is in and of itself a significant level, but now you throw the 200-day moving average pretty much right on it, and now it's even more significant. A break, since we've been converging for so long, a break of that with smaller and smaller compressing ranges suggests that at some point in time, sooner rather than later, it will uncompress, right? And especially with how low the long-term average value is, it will set us up for a move up towards the 20s in that case, which, considering where the average values are, a move to 20 right now would be pretty darn significant. All right, now let's take a look at what's driving this price action over the last 3 months. Q's up 15%, S&P's up 13%. Let's just take a look at today alone. So here's today's move. You can see gold, which has been a big performer lately. It was still up today with the drop in the dollar. Again, you can see bonds down a little bit, so yields up just a smidgen. The commodities up a little bit as well. But the Qs continue to be the big driver. Again, remember how we've been on kind of a quasi risk-off move since last Wednesday, with gold really ramping up and TLT ramping up. Well, over the last couple of days, that's turned around. So Qs have really in the last 2 days have taken off to the upside. So if I were to go back to 3.6, things have definitely changed with that weakness in the dollar really driving a big push in international equities, domestic or developed as well as emerging, as well as just the Qs in general, really pushing things. And IWM has been trying to keeping pace with the broader market. just not able to keep pace with a handful of the stocks that are in that Mag 7. Remember, these 12 stocks that are in this make up 50% of the Qs. So this is essentially the Qs, what really matters. And of course, the NVIDIA up 98.88% in the last 3 months. And AMD up 64%, and Meta up 56%, and Broadcom up 52%, with Amazon and Netflix kind of falling behind there. No matter what you're seeing on these others, 3 consecutive oversold clusters on Apple, an oversold cluster yesterday on Google, and Tesla, dark pink shading. None of this really matters when you've got 98. Essentially, when you look at, I saw something today that said that NVIDIA has added $1 trillion worth of over $1 trillion worth of market cap this calendar year alone since the beginning of the year. Remember, in 3 months it's up 98%. So if that's the case, then that means in the past few months we have essentially added to the S&P a company out of nowhere, out of the blue, that is the size of Meta, which Meta would be 1, 2, 3, 4, 5, 6 biggest company in the S&P 500 if you count Alphabet as one. So we have 1, 2, 3, 4, 5, 6 companies that are $1 trillion or more market cap. Meta being the smallest. After that, it drops down to Eli Lilly at 740,000. Berkshire Hathaway, which is always traditionally up here, one of the bigger market caps, is down to only 5. It pales in comparison. Microsoft is 6 times the company right now that Berkshire is on a market cap weighted basis. But yeah, we've essentially added to NVIDIA another company, a separate company, the market cap size of Facebook, of Meta, which is the 6th largest company in the S&P. So you can see why just like one stock can have that much of an impact on the broader market as a whole, because of how big it is, right? How big it and again, the impact that it's having. You look at the sector comparison chart and you see XLK, which NVIDIA, Microsoft, Apple, and NVIDIA are all part of XLK. Apple traditionally was the biggest component of that. Microsoft is now, but NVIDIA is catching up very rapidly. So again, if I were just looking at today alone here, then you can see XLK and XLC, which again are basically your 2 AI sectors, because XLY has traditionally been one of those 3 sectors that's associated with the cyclical areas here. XLY has not been performing. In fact, since the beginning of the year, let's just go year to date here, it's pretty much been an XLK and XLC world, and XLY is barely positive for the year, and they're up almost 10%. Financials are doing well too. Healthcare, of course, is doing well with the GLP drugs, and industrials have been matching the S&P 500. Other cyclical areas, materials and energy, really gaining on the weakness in the dollar here lately. And then utilities and real estate also really gaining on the weakness in yields here lately. So those interest rate sensitive areas still strong. You look at the 10-year yield, which has been kind of sitting on its 50-day moving average. Got a little bit below it today. MACD is still down, negative, below its below 0, below its moving average. The dollar was another one that really broke its 50-day today pretty hard, hence the really strong bullishness in the market the past couple of days. That's really, if you look at the last 2 days of weakness in the dollar, if you take a look here at the impact that's had just over a 2-day time frame. I think I might have shown this before, but we'll look at it again. So this is over the last 2 days. There it is. Again, Qs and international equities really benefiting from that, from the dollar dropping as sharply as it. Gold really benefiting, commodities really benefiting. These are all kind of anti-dollar trades, and it appears that the dollar is starting a new decline. You're already below the 200, so you're significantly below the 50. That's not just a little drop, like barely a toe dip. You're pretty, now granted, we got about that far down there before and then rebounded, so we'll see if that ends up, but we were already below the 200-day there. The rebound didn't last very long before you really fell down again. So it appears that the dollar is starting a new decline And that will be very beneficial for the current. You can see dark pink shading in a red line. The intermediate line crossed below its market sentiment. Very bearish short-term sentiment there. The 10-year yield, the intermediate line's almost out of bullish territory. You have a red line on that. Then really only commodities is that three-headed monster, and it just can't get going to the upside as crude oil has been really converging and not moving. If you look at, I think we looked at this last night, but if you look at the Bollinger Bands of crude oil, the band width has just really come down to like extremely low levels. So we're really setting up for a move on crude oil one way or the other. But considering the moves on yields and the breakdown in the dollar, now you might anticipate that the crude oil will probably break down to the downside and really help fuel the continuation of this strong bullish move in the equity markets. That takes us to our trade of the day. I want to actually look at Constellation Brands here. It looks actually very similar to the chart of crude oil. Obviously, this is a staple company. But look at the breakout after a pretty decent period of consolidation that brought the bandwidth down. Look at the breakout that we had today. Big breakout outside of the bandwidth. The bandwidth is way inside the Keltner channels, but you broke way up above that band and also above the upper Keltner channel. Big move to the upside. The momentum is rising. You're probably maybe a day or two away from getting green dots with the bands moving outside the Keltner channels. You close above multiple highs here, and you've got dark green shading and a green line again after getting those bear tags. The intermediate line crossing above the market sentiment, crossing above the 60th percentile. So a good move from that perspective. Obviously crossing above, actually didn't cross above any moving averages because you're pretty much sitting on all of them. For the past so many days, you had every single one of these moving averages that we look at. They all crossed through the range. 1, 2, 3, 4, 5 days in a row, you had all of these lines. How many of these? 1, 2, 3, 4, 5. All 5 lines crossed through the range of the last 5 days. And plus a few more before this one here. But not today, right? Today in fact, only really the 8-day is crossing through the range as we gapped up here above these moving averages and now really pushing out, breaking out here. The 8 and 17 have already crossed the 30. They're about to cross the 200. MACD and stochastics turning up, as you can see, just turning positive on the MACD, but they're easily now to bullish levels. You see kind of an odd, because of that consolidation, an odd DMI chart. The not Seagate, it's Constellation. The negative indicators already below, but you can see, like, unlike this move or even this move where they came at the end with strong bullish lines at high levels, this bullish line just barely crossed above 25. So it's just kind of barely starting a bullish run. The RSI and the CCI predictably also broke above bullish levels there. And then you also finally got on the upper side of the Ichimoku cloud, right, with the green line above the blue, the rate of change turning positive. You have a weak bullish trend starting, moving your way up towards intermediate trend strength. So what I decided to do here was take a look at the April options and sell a bull put spread. At the time it was at a 40 delta. Now it's at 35, so selling to 250, buying to 245. Again, we did this during the Market Outlook Live. We already put it on. We got $1.30. It looks like we got $1.30 out of it on the spread. And we ended up getting about we need to get at least $1.16 to get a 30% return on risk, and we're at $3.90 for that $1,100. So the spread ends up being here, not at the break even, not at 248.45, ends up being at 248.70. That's $1.30 below the short strike price. So if I were to throw that onto the chart, you can see, 258.70. No, 248.70. Again, that's the credit. That's the short strike price minus the credit. If I were to add that slice to the chart, so you can see now we basically have to pretty much completely undo today's breakout move for us to get to the point where we would be willing to lose $390 in this case, because that's the credit that we're shooting for. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.